All right, let's get right into it. Today, we're doing a deep dive into an automated technical analysis report for the stock known as GUTS. We're going to crack this thing open and see what the data is really telling us.
Okay, so first things first, let's get our bearings. As of September 28, 2025, when this report was run, the price of GUTS is $1.34. That's our starting point. So that's the price on the sticker, right? A simple number. But the real question, the one we're here to answer, is what's happening underneath the hood. What are all the technical indicators whispering, or maybe even shouting, about where this stock might go next?
Well, the report certainly doesn't bury the lead. After crunching all the numbers, the final bottom line signal from the system is a buy, plain and simple. The algorithm is bullish. But hang on, here's where it gets really interesting. Even though the final signal is buy, the confidence level is only medium. Now that's a huge clue. It tells us there's some push and pull in the data. Not all the signals are singing the same tune.
So how in the world do you end up with a buy signal that the system itself is only kind of sure about? To figure that out, we've got to look at the breakdown. Let's see the balance of power between the good signs and the bad signs.
And there you have it. It really just comes down to simple math. You've got 4 distinct indicators flashing green, telling us to buy. And on the other side, you have 2 indicators flashing red, telling us to sell. It's a 4-2 vote, and the bulls take it. But those 2 lone sell signals are the entire reason for that medium confidence. They're strong enough to be waving a big yellow caution flag. So what are they, and what exactly are they trying to warn us about?
Before we see the specific warnings, you've got to understand this one critical term, overbought. The best way to think about it is like pushing a car's engine into the red zone. Yeah, you're going super fast, but you can't stay there forever. It means the price went up so far, so fast, that it might be running out of gas and is due for a cool down, or a pullback.
And boom, here's the evidence. Both of those red flags are screaming about this exact overbought condition. First, the RSI is up at 73.37, and pretty much anything over 70 is considered to be in that red zone. At the same time, the price has literally punched through the ceiling of its Bollinger Band, which is another classic signal that a move might be overextended.
So this is it. This is the whole story in a nutshell. It's a tug-of-war. On one side, you have the risk of this overbought engine blowing a gasket. But on the other, you have this powerful, undeniable upward momentum. Which one is going to win?
To figure that out, let's flip the coin. We've heard from the bears. Now let's give the bulls their turn. What are these 4 supporting factors that are so strong they're convincing the system to say, buy anyway?
Okay, let's break down the bull case, point by point. First, moving averages show the price is above its short-term trend. That just means its recent direction is clearly up. Second, momentum is strong. This means the price isn't just rising. The speed of the rise is actually increasing. That's a sign of real power. Third, the trading volume confirms the move. There's real money and conviction behind this rally. And finally, and this is a big one, the price is holding at a key Fibonacci support level, which is like a line in the sand for a lot of traders.
And just look at this. This might be the most compelling piece of evidence the bulls have. Look how incredibly tight that is. The current price is sitting almost perfectly on top of this critical Fibonacci support level. It's like it came down, hit a trampoline, and is bouncing right off. For technical traders, that is a huge green light.
So we have this battle, these loud overbought warnings on one side versus strong momentum and support on the other. How can both be true at once? Well, this whole confusing picture starts to make a lot more sense when we just zoom out and look at the stock's wild history.
Man, this stock has been on an absolute roller coaster. Back in July, it was flying high near $2 a share. Then, bam, it got absolutely crushed in August, falling all the way down below $1. And what we're seeing today is this powerful recovery attempt, clawing its way back to that 134 mark.
And that context, that's the key that unlocks this whole puzzle. A super fast, sharp recovery after a deep, deep fall is the perfect recipe to trigger both of these conflicting signals at the same time. The sheer speed of the bounce gives you strong momentum, but that exact same speed is what triggers the overbought warnings. They are literally 2 sides of the very same coin. So, the report's final verdict is this. It sees the risk. It acknowledges the engine is running hot, but ultimately, it's decided that the strength of the upward momentum, combined with the fact that the stock is holding that critical line of support, are simply the more important, more powerful factors at this exact moment. And that leaves all of us with the big $1 million question, doesn't it? Is this data capturing the very beginning of a true sustainable comeback story from the lows, or is this just a volatile, overbought bounce that's about to run out of steam and fail? That is the crucial question this report leaves us to think about.